Hello guys, and welcome back to another video. In this video, we are going to share with you some techniques that will completely change the way you look at charts. Basically, we are going to reveal some advanced techniques and secrets about price action trading that will transform your approach to reading charts. Until now, you might have learned the basics: support, resistance, selling at resistance, buying at support, buying breakouts, or selling during traps. These are the fundamentals you probably already understand. But now it's time to take this to a more advanced level. Whenever we try to read any chart, the first and most important thing we need to understand is support and resistance levels. However, it's crucial to know which supports and resistances matter. The strong support and resistance zones, where smart money, institutions, and banks are involved, these are what we refer to as heavy supply and demand zones. So the first thing we are going to cover in this video is how to identify a true supply and demand zone. This is our point number one. Watch this video until the end, because we guarantee by the time you finish it, your perspective on chart reading will change completely, and you'll be grateful you watched it till the end. First, let's understand how to identify a real supply and demand zone. Take a look at this zone we've marked, a support zone. Why is this a demand zone? Suppose buying activity starts from this zone. Is it just a regular support zone or a proper demand zone? As of now, this is just a normal support zone. But what makes it an institutional support zone? An institutional support zone is where banks, institutions, or smart money are involved. Areas where we know heavy buying happens, and when the price returns to these zones, it often leads to another bullish move. This is how institutional zones get created. This behavior often follows a break of structure. For example, let's say a swing is formed here. When the chart breaks out of this swing and continues higher, usually it will make a trap move first before moving up. This is typical behavior on any chart. But when smart money is involved, the behavior changes. The swing breaks out instantly and shows no respect for previous levels. This is what we consider institutional buying or selling behavior. Let's look at some examples. Here's one. There was a trend line, and after it broke, there was a steep sell-off. In this steep selling, a clear zone formed. You can see many such zones or swings here. But did we observe any significant pullback? Not really, just some minor wicks, but no proper pullback. A steep sell-off occurred from here. Therefore, we would call this an institutional selling zone or heavy supply zone. Terms like strong resistance, smart money, or order blocks, they all mean the same thing but are named differently in various concepts. This is a solid supply zone. We would prefer to extend this zone forward, and whenever the market returns to it, we would definitely look to create a sell-side entry because we know this area will likely bring strong rejection. That was example number one. Moving on to the next, there was a trend line being followed, especially in gold, which we had mentioned in previous videos. The market showed buying from this trend line. There are swings visible here, but none of them were heavily respected, and a steep bullish move followed. Now, would we call this a normal support zone? Let's explain this scenario in detail. Notice here, a support zone formed and was respected multiple times. 1, 2, 3, 4, 5 times. Normally, logic would suggest a breakdown should happen after so many tests, as repeated tests can weaken buying strength. Previous highs are reducing, so buying could be weakening too, leading to a potential breakdown. But did a breakdown happen? Instead, we observed a steep bullish move in the opposite direction. This indicates that smart money or institutional involvement was present around this zone. Whenever the market respects this zone again in the future, buying opportunities will arise, which is exactly what we observed. Even with the steep move, this wasn't institutional behavior. Let's understand why. Look at the chart's behavior. This support zone had already been tested multiple times. Even after moving higher, the market returned to this same zone. Tested once, twice, thrice, and then again. A small bullish move appeared, followed by a breakdown. After the breakdown, notice the wick, indicating a breakdown followed by a move back up, possibly for stop-loss hunting or trapping. The market moved up sharply to trap buyers and then finally fell to sweep liquidity. But eventually, the market bounced back from this zone. Why did we mark this zone? Let's go back and observe. This wasn't even a support zone. It was a resistance zone. Remember, resistance becomes support. There's no fixed thing as just a support or resistance. Zones are zones. Above equals support, below equals resistance. This zone also acted as a strong institutional selling zone previously due to repeated steep sell-offs from it. But that's not the only logic behind calling it institutional. Another reason is heavy liquidity. Repeated big sell-offs indicate heavy liquidity at this zone. When it finally broke out, notice the breakout behavior. Did a trap occur first? Did it gradually move up? That's why we had set targets up to this zone. If we were marking normal support zones, we would have marked these too. The market broke through them easily. The respect came from this high liquidity zone. That's why it's critical to mark true supply and demand zones, not normal ones. Now, let's discuss liquidity a bit further. You already saw this example of heavy liquidity leading to a massive breakout. Let's analyze this recent selling area. We marked this zone because it was a swing point. Typically, a swing forms, breaks out, and the market retests. First breakout, buyers enter. Retest, more buyers enter. Finally, the previous swing breaks. More buyers enter. This pattern invites buyers 3 times. It's not just an M pattern, it's a liquidity grab pattern, inviting buyers thrice and finally trapping them before falling. The same concept works in reverse for sellers. Breakout, retest, swing break, then continuation upwards. People often say it's a simple W or M pattern, but that's not the real logic. There's deeper reasoning you need to understand. These two concepts, institutional zones and liquidity, are how markets operate. You need to read charts this way. Where are buyers entering? Where could they be trapped? Where are sellers weak? Where might sellers get trapped? Where are sellers entering? Once you start analyzing markets this way, your predictions will align with reality. You'll understand the likely direction. And once you grasp the direction, you just need to trade logically with proper stop-loss placement. Your targets will be hit consistently. We hope this video helped you understand these concepts. If you found value in this, like the video and subscribe to the channel. Thank you so much for watching. We'll see you in the next video. Until then, goodbye.